Booyah! Welcome to another wild week on Wall Street, where Washington's political gridlock has triggered a government shutdown. The political drama in the nation's capital is sending shockwaves through the financial markets. As of October 4, 2025, the U.S. government is closed for business, and Wall Street is on edge. Traders are anxiously watching every move, every headline, trying to predict what comes next. This isn't just political theater. When Washington stalls, markets get nervous. The uncertainty can lead to volatile swings in stock prices and investor sentiment. Investors hate uncertainty, and a shutdown brings plenty of it. Delayed contracts, worried consumers, and a ripple effect that can touch every corner of the economy. And a potential hit to corporate profits. Companies are already bracing for the impact, with some revising their forecasts and tightening their belts. We've seen shutdowns before, but this one comes as the market sits at record highs, making everyone extra jumpy. The stakes are higher, and the margin for error is smaller. The big question, is this just a temporary speed bump or a sign of deeper trouble? Analysts are divided, with some predicting a quick resolution and others warning of prolonged uncertainty. For now, Wall Street is glued to every headline out of DC, bracing for impact. The next few days will be crucial in determining the market's direction. But don't panic. Focus on the fundamentals, not the noise. Long-term investors should stay the course and avoid making hasty decisions based on short-term events. This shutdown is a headline, not the whole story. Let's dig deeper and understand the broader implications for the economy and your investments. Despite the ongoing chaos and uncertainty swirling in DC, with political headlines dominating the news cycle and lawmakers locked in heated debates, the stock market is charging into the fourth quarter with serious momentum, seemingly unfazed by the noise coming from the nation's capital. The S&P 500 is up 14% this year, hitting its 30th record high just last week, a remarkable feat that's caught the attention of investors everywhere. This isn't a fragile rally built on hype. Solid corporate earnings, robust consumer spending, and relentless innovation are driving real, sustainable growth. Investors are piling in, eager not to miss out, fueling a powerful feedback loop that's kept the bull running strong and confidence soaring. Of course, being at record highs means there's always room to fall, and the bears are quick to warn of a looming correction or sudden reversal. But so far, the market's underlying strength and resilience have overwhelmed the doubters and silenced many skeptics. Confidence is high, and that kind of optimism doesn't just vanish overnight because of political drama or short-term headlines. The risk is real, and investors know it, but so is the underlying momentum that's been building all year. The bears have been losing this fight all year, watching as the market continues to defy their expectations. For now, the bulls still in charge, leading the way as Wall Street's optimism shows no signs of slowing down. Here's the real problem with the shutdown. Beyond the headlines and political drama, it quietly grinds the gears of the financial system to a halt. It creates a data drought, cutting off the steady flow of crucial economic information that markets and policymakers depend on. The Federal Reserve relies on timely government reports, like jobs numbers, inflation stats, and retail sales, to decide how to set interest rates and guide the economy. With agencies shuttered, that data simply vanishes, leaving the Fed flying blind and unable to make fully informed decisions. No data means no clear path for rate cuts or hikes, and that uncertainty ripples through the markets, rattling investors and traders alike. The market was counting on more Fed easing to keep the rally alive, hoping for lower rates to fuel further gains. Now, with key reports delayed and uncertainty mounting, the bulls are getting nervous and optimism is fading. If the shutdown drags on, the data gap only grows wider, and so does market anxiety, as everyone waits for answers that aren't coming. Some strategists believe that once the government reopens, pent-up stimulus and delayed decisions could spark a sharp rebound in both data and market activity. But until that day comes, we're stuck in limbo, waiting for clarity, with each passing day adding to the uncertainty. The Fed's next move is anyone's guess, and for now, the entire market is left holding its breath. Let's zoom out. History says the fourth quarter is the market's sweet spot. Since 1928, the S&P 500 has averaged nearly 3% gains from October to December. Holiday spending, year-end optimism, and fund manager moves all fuel this seasonal surge. Even during past shutdowns, markets have often shrugged off the noise and pushed higher. Most analysts expect this shutdown to be a temporary distraction, not a disaster. The fourth quarter's track record is a powerful tailwind. Volatility may spike, but the dominant trend is upward. History favors the bulls in Q4. Don't ignore the seasonal strength. The odds are on the market's side. So, why aren't the pros panicking? Two reasons: earnings and easing. Corporate profits are surging. Analysts expect nearly 9% growth this quarter, and estimates keep rising. Strong earnings are the ultimate fuel for a bull market. The Fed, despite the data drought, has already cut rates to support the economy. Lower rates make stocks more attractive and borrowing cheaper. Most experts see the shutdown as a short-term nuisance, not a game changer. The market is strong, the Fed is supportive, and earnings are booming. The smart money is looking for opportunities, not running for the exits. Fundamentals and Fed policy are keeping the bull alive. Don't bet against this market.